Behind the Ticker is brought to you by UX Wealth Partners. If you're a TAMP user and you're sick and tired of the legacy technology they are run on and you want more customization and flexibility, as well as a AI-driven model marketplace, UX Wealth Partners is your destination. On top of that, they have institutional trading. So if you are an ETF issuer or an SMA provider looking for outsourced institutional trading, UX Wealth can also be your destination. So check out uxwp.com to find out all the ways UX Wealth Partners can help grow and make your practice more efficient. Welcome to Behind the Ticker. Today we have on Brad Neuman. He is the Director of Market Strategy and a Portfolio Manager at Alger. And we are talking about their ETF, which is the Russell 1000 Innovative Companies ETF, ticker INVN. This product seeks to invest directly in innovation by identifying companies with very strong R&D investment that is underappreciated by the market. They call it the hip stocks, highly innovative, but prudently priced. So without further ado, please welcome Mr. Brad. Hey, Brad, welcome to the show.
Hey, Brad, great to be here.
Yeah, first time we've got two Brads on the show. So, but no, I appreciate you doing this. And before we get started, why don't you give everybody a bit about your background and how you ended up at your role over at Alger?
Sure. Well, I've done a lot of things in my 25-year career. I've been an investor and managing money and an analyst. I've also been a sell-side publishing analyst. And I've done those things both bottom up, so analyzing companies, one by one, as well as top down from a systematic or strategic, big picture. So I started off working on the sell side, doing equity research in home building and housing products and wireless telecommunications. And then I worked for a couple of chief investment strategists at a large sell side bank. And then spent a decade at a couple of hedge funds managing money until I came to Alger a little over 10 years ago. And at Alger, I am the Director of Market Strategy. So I publish our thought leadership, and I also am the Portfolio Manager on the recently launched Alger Russell Innovation ETF.
Yeah, and that's what we're going to be talking about today. I want to dive into that product specifically. But before we get too in the weeds and too into the business, any hobbies? What do you like to do when you're not working?
Well, I have three young kids, so they keep me busy. I do like tennis a lot, and actually they're involved in tennis. So it's me playing plus me coaching them and shuttling them around to different tournaments and stuff like that. So that keeps me busy. I'm also kind of obsessed with anything, activities on the water and being on the water. And so kayaking, paddleboarding, boating, all that kind of stuff. So yeah, that's pretty much it.
Yeah, it seems to be the most recent set of answers when I ask this question is everybody has young kids and they seem like they're just shuttling them around. Seems to be the hobby of most these days. But so can we talk about Alger as a whole? Like, you do more than just ETFs. You guys have I was looking at your website, you have a lot going on there. So can you just talk about all the things that you guys are doing for clients on a day-to-day basis?
Sure. So, Alger's been around for over 60 years. We were founded in 1964, one of the pioneers of growth equity investing, always been kind of on the leading edge of innovation. And, our business, which is, we manage about $25 billion in assets, is split between institutions and retail. And so, on the institutional side, it's endowments and pension funds, things like that. And then the retail side, we generally sell through financial advisors and more recently moving from mutual funds that are distributed through financial advisors to ETFs. So we have 6 ETFs. that are available for purchase by individual investors or through financial advisors.
So can you talk about, maybe the overall investment philosophy of the firm? Like, how do you guys approach, building portfolios, building strategies? Is there kind of an overall theme or mantra as a firm that seems to kind of flow through everything you do?
Yeah. So thankfully, we've had one philosophy that's been in place for, like I said, over 60 years, and we haven't had to modify it. And it's called positive dynamic change. So this is Fred Alger's philosophy when he founded the firm. Essentially, where there's change, there's opportunity. And opportunity is a big driver. I think of the big drivers about performance as opportunity times skill. So it's not just how skilled you are, it's also where there's a lot of dispersion of potential returns that you can outperform. And so areas of change are where there's a lot of dispersion of returns. And so if we can apply skill to those areas, we outperform. And, we think change begets growth, and growth begets value creation. And so we go to where the change is, and that change is kind of two types. High unit volume growth, which is kind of your traditional growth companies that are gaining market share rapidly. And the second one is a positive life cycle change, and those are companies that are going through a growth renaissance, maybe because of new product introduction, M&A, or new regulation, et cetera, new management.
It's interesting. So just kind of staying on that for a little bit, are you using, I guess, like some fundamental screening factors to identify those types of opportunities and find where that change is occurring? Or like, how are you guys doing your analysis to really pinpoint those opportunities for the portfolios?
So the way we do it, and have done it for 60 years, is generally bottom up fundamental investing. So we've got a whole team of analysts that are experts in their industries, and we do a lot of proprietary field work. So we talk to customers, suppliers, competitors. I wish there was a simple formula for how we did it, but if it was, then it could be duplicated. It's, think about, your favorite sports analogy, a football game. The best football team, yes, they have talented players, but a lot of it comes down to just, the executing, the practice, all the little things coming together. So because our ear is to the ground, we're finding where there's change and finding, where companies are gaining market share, or where they have a product that may begin to gain market share. And that's kind of the way we do it. Most recently, with the launch of the Alger Russell Innovation ETF, which I know we're going to get to in a bit, we've just started to do this systematically top down, and that does use kind of a quantitative screening mechanism that we can talk about. But generally, most of Alger is bottom up fundamental.
Got it. And yeah, I mean, I do have that on the list. I saw that as I was kind of doing some due diligence on the fund. And so let's talk about the Alger Russell Innovation ETF. The ticker is INVN. So can you talk about what inspired the creation of this ETF, and really what gaps are you trying to fill in the market?
Yeah. Well, I think it's really unique, and I think there's a huge gap in the market. So that's the exciting part. So first off, innovation is more important than ever before. We think the speed of disruption is accelerating. So innovation is really important. And there's kind of two ways that I think investors can try to invest in innovation. One is, the bottom-up fundamental way that we talked about. And two is try to figure it out in a systematic approach rather than an idiosyncratic approach. So in other words, come up with some kind of methodology that invests in innovation, we'll say, as a factor. That second way of investing has not existed, I don't think, before we created the Alger Russell Innovation Index and the ETF that tracks it. So, when we've asked investors in the past, we've done surveys with folks like Greenwich Associates. We've surveyed institutional and retail customers, investors. Do you think innovation is important? We just did this the other day also on a webinar. Almost everybody thinks innovation is important and you should have it in your portfolio. But then when we ask investors, how do you measure innovation, and can you define it? We get most people, not knowing how to define it or measure it. So that's the big gap. The big gap is how do you invest directly in innovation? Measure innovation, then invest directly in it. And that's what I think we're solving with this Alger Russell Innovation Index and the ETF that follows it. It's unique and it invests directly in innovation. And we think that it's identifying innovation that's undervalued, potentially finding innovative assets before other investors.
So when you kind of think about innovation as like this investable theme, how are you simply avoiding just like buying the hype or overpaying for excitement? You think about, most recently it was just, AI chips, right? And I looked at the portfolio and kind of how it's constructed, and it's not constructed that way. So how are you as a firm or you as a portfolio manager thinking about this theme, which is innovation?
Well, one of the beautiful things about, in my opinion, the index and the ETF that follows it is that it has very little overlap with the benchmarks. And, I think most people will find some relatively significant portion of the Magnificent Seven in their portfolio today. This has, a high 90s active share percentage, meaning more than 90, high 90% of the strategy or ETF is different than the benchmarks, whether you look at the S&P 500, the NASDAQ Composite, the Qs, the Russell 1000 Growth, any of those things. So it's really different. So your question is, how is it avoiding stocks that are just simply, have a lot of momentum or something like that? And it is, not only is it different than indexes, it's very attractively valued. So I call it, your listeners probably heard of GARP, growth at a reasonable price. I call this strategy HIP, HIPP, highly innovative but prudently priced companies. So the reason we can do that is through the methodology and the fact that we tie research. We don't just invest in research and development. We invest in research and development, companies that spend a lot on research and development that's being undervalued by the market. So it's research and development relative to market value. So maybe it's helpful now if I take you through just the whole methodology. It's not that complicated, but so we start with the Russell 1000. And we only really do two things to the Russell 1000 to get down to the portfolio. We first weed out the bottom 1/3 of free cash flow margin companies. So the worst companies ranked by free cash flow relative to revenue. Why do we do that? Two reasons. One, we don't want very early stage companies. You can imagine if you were just investing in R&D, maybe you'd get a lot of biotech companies that are pre-earnings or maybe even pre-revenue. We didn't want that. We also didn't want to invest in companies that were spending a lot on research and development but weren't successful with that spending. We want companies with a proven track record of turning that research and development into commercially viable products that produce free cash flow. So to do that, we weeded out or eliminated the bottom 1/3 of free cash flow margin companies. So we start with the Russell 1000. We're left with the top 2/3 of free cash flow margin companies. From those companies, within those companies, we simply rank them all by research and development spending over the past 12 months relative to their market value, or to get technical, their enterprise value, which is the market capitalization of the equity plus the value of the debt, plus minority interest and preferred stock, less cash, but essentially the market value of the company. So we take the top 50 companies ranked by research and development to market value, we equal weight them, and we reconstitute that each quarter. Or I should say Russell does this. We came up with this methodology, brought it to Russell. They were very impressed with it when they studied how it had performed in the past. And so they are the ones who determine the constituents of the index. Now all we have to do is manage an ETF that tracks this index.
So you talked a lot about a different metrics that the index uses, such as free cash flow margin, R&D to enterprise value ratios to help kind of like select these companies. Why are those metrics so important to really identify innovation? Like, why is that really key here?
So, there's been a lot of academic research on this. That research and development companies with strong research and development have gone on to have strong sales and earnings growth, and that's in the public domain. Several papers that have been published about that, and so Baruch Lev, in particular at NYU, has come out with some of those findings, and so research and development is, we think, indicative of new products and services that may be commercially successful. But research and development relative to market value, we think, shows where the market is undervaluing that research and development. So, for example, I get a lot of questions of, well, if the strategy is so innovative, how come it doesn't own Apple or something like that? Which everyone probably thinks that Apple's a pretty innovative company, right? Well, I think the issue there, why it doesn't own Apple and many of the large companies that we all think of as innovative, is because we are using that research and development relative to market value. So Apple may be innovative, although I would argue that their innovation is very visible. Everyone knows that they're going to come out with another phone, every September. And most of the value of the company is actually based on its existing products. So I wouldn't say, and the model wouldn't say, that Apple is undervalued based on its research and development pipeline. That doesn't mean it's not a great company or even a good stock. It's just that the model wouldn't say that its research and development is undervalued. So the weighted median research and development relative to market value in the ETF is about 6%. So you're talking about these $3 trillion companies. They are very innovative, and they might spend tens of billions of dollars on research and development, but they don't spend what's necessary relative to their market cap, which in this case, would be $150, $180 billion to get them included in the index. So it's just a question of valuing that research and development.
Yeah, no, it makes a lot of sense to me. I couldn't imagine spending $180 billion on R&D. But the fund is equally weighted. And so what was the decision going into that to kind of, instead of to equal weight all these selections rather than maybe a more traditional market cap weighted approach?
Well, we did a lot of work on, it's really the innovation factor, the research and development enterprise value that we believe is the signal here. And so simply having a larger market capitalization doesn't make that, signal or score on that metric any better. So that's one reason why we wouldn't do it. We really just want to have broad exposure to that innovation factor, as I would call it. And the best way to do that, make sure you get that, is through equal weighting. We also, one of the beautiful things about this strategy also is that you don't have to, many other factors, if you can find a factor that works, many factors only work for a short time. If you think about like earning surprises and things like that, if they work, they only work, we're talking days or weeks. Our belief is that this is a much longer term signal, the innovation factor, and so we don't have to turn the portfolio over very much. That's why it's only quarterly, and that actually allows us to hopefully avoid some capital gains for the investors, because instead of selling stocks that have appreciated, we're able to exchange them in kind. So that's another advantage to the portfolio.
And just out of curiosity, like how often are you turning over the portfolio or rebalancing?
Yeah, so it's just once a quarter, I should say. Sorry, 4 times a year. On average, it's about 8 stocks that enter and exit on that quarterly basis. But and we've only launched it this past January, so that 8 stocks is just if you went back and looked at it historically, using this methodology. But we've only had 1 rebalance so far in March, and there was 4 stocks that entered and exited the portfolio.
So innovation and thematic, innovation ETFs, we've seen a lot of launches, whether they're passive, whether they're active. So what would be, kind of the main differentiators between your product and some of the other thematic innovation ETFs that we've seen hit the market more recently?
So I would say almost all the ones that you're talking about are, qualitative rather than quantitative. They're things that people think are innovative. And This is quantitative and systematic. And I think that has, a lot of advantages. One of them is just that the story doesn't have to get out and be told to, investors. The CEO doesn't have to get on the road. This strategy can simply evaluate where there's a lot of research and development in a company that's been that's generating free cash, where there's a lot of research and development. It's not being valued a lot by the market. So it's able to find some I think under the radar companies. Like there's a stock in there right now in the portfolio called Solventum, which most people haven't heard of because it's a healthcare spinoff from 3M, and it's only been in existence for now just about a year. So it's systematic. That's a huge difference. And then if you can find any other systematic innovation strategies, I don't think any invest in the innovation factor as we've defined it, where you're looking at innovation relative to market value. So I think it's pretty much the only option out there that does this.
So if you're sitting down, you're having a conversation with an advisor, they have their firm's model portfolio. How would you position this ETF? Where would you put it in terms of allocation? Would you complement it with something like? How would you fit this in kind of an already diversified model portfolio?
So the easy answer to have it match just to the traditional thought process of most investors is that this strategy maps to mid cap core. So it has elements of value and growth. Again, it's something new. It's innovation. So I don't know that, like, say, the Morningstar style box defines it correctly. But if you're going to use the traditional Morningstar style box, it maps to mid cap core. We think it can be a replacement for some of your either mid cap core active strategies, or maybe more in particular passive strategies, in that it solves a couple, I think, of the passive problems that people have now, which is one, overexposure or concentration to large cap tech. Like I said, this has very little exposure. The other big problem it solves is the elevated valuations in the market, particularly amongst the largest companies. The valuation, as of March 31st for this portfolio ETF, free cash flow, price to free cash flow was 12 times, which is just about half that of the Russell 1000 index and way less than half of the Russell 1000 growth, which most people think of as an innovation index. And then the harder answer is this is probably the first time that, in my opinion, that investors can invest directly in innovation. And so how big should your, innovation allocation be? So, and that's something people have to wrestle with. Yeah. There is actually there's a paper that Russell wrote about this that people might want to check out on Russell's website.
Yeah, no, I think you got the timing here is really good. I mean, mid and small has been unloved, as you said. Large cap has largely dominated. Large cap tech has largely dominated for the better part of maybe 3 years now. And so some of that mid cap exposure, as well as some equal weight. Since it is kind of a relatively newer ETF, as you said, it launched in January. How are you, as a firm, kind of thinking about marketing and distribution and getting this in front of people? Because that tends to be the hardest part as we launch new ETFs.
Yeah, well, you probably know all about this, probably better than me. Like I said, Alger had grown up around mutual funds, and that has been our kind of bread and butter on the retail side. Obviously, we do separately managed accounts, et cetera, on institutional side. But on the retail side, it had been mutual funds, and we have huge presence in a lot of the large wirehouses. When you start an ETF from scratch, as we did just a few months ago, a lot of those wirehouses want longer track records or significant AUM that's not possible from day one. So we have to market this ETF and our other ETFs more to RIAs and kind of independent advisors. And so that's what we're doing.
Yeah. Well, Brad, I really appreciate you spending some time with me. Before I let you go, where can people learn more about the firm and get information on your ETFs?
Yeah, so I would definitely encourage people to go to alger.com. You can find this strategy, a link to this strategy there. If you go on the strategies tab, you can also find a lot of other thought leadership that we've done under the insights tab. So there's plenty there. And there's a video where I walk through the methodology, et cetera, and the how this strategy came to be on the website, on the product page.
Well, again, Brad, thanks for being here with me today.
Thanks so much for having me. It was great.